Good morning and welcome to the Investing Master Series. My name is James Boyd. We welcome everyone here today. We have Brent Moore's with us in the chat, a fellow instructor. We welcome him. You'll see his initials as BM. Today's date, December 9th, and that means there's about 2 weeks to Christmas. So I don't know if you've gotten started yet with the presents. Do not follow my example where one year I went to Best Buy at like 3 o'clock in the afternoon and the mall. Disaster. Okay, so not a bad idea to kind of get properly prepared sooner than later. Don't leave it to the very end. Now, just real quick, you can follow Brent and myself on X. There's my handle at James Boyd CS. And also remember that we do post educational announcements, example given. So we actually go to that page. This is what it's going to look like. Notice it's capital J, capital B, CS. We never reach out to someone and try to solicit anything. If that happens, you know that's not my page. Okay, or me. Also remember that occasionally we do post some fun things as well. And you're going to see that little fun there. But also what I want to kind of show is just real quick, I will be, and you've asked that if I would let you know, so I'm just letting you know, on December 23rd, we'll cover for Ben Watson on futures at 9:30 a.m. Eastern. So I put that there as well. Now, also remember that as we actually talk about some of the things today, it's done for informational purposes only. We're going to talk about stocks and options. So this class, we do stocks. Fridays, we talk about ETFs. We also, for example, in this class, we'll talk about heavily covered calls, married puts, which is a stock and a buying the put example together. We talk about callers, okay? We talk about, for example, like verticals and cash secured puts. Those are staples of when we talk about Investing Master Series. So you really want to kind of be thinking is, now, by the way, when we talk about those 7 strategies, do you have to do any of them? No, you could choose what you want. But since it is a class, we try to have some curriculum that we actually talk about besides just talking about ABC. So remember, you get to choose. Now, also remember when we talk about our examples, we'll do those in the Paper Money software application. Investing has risk. Without the risk, there wouldn't be a reward, potentially. And also remember when we talk about short options, cash secured puts, covered calls, anything that you sold, okay, a call or put, those can be assigned at any time up to expiration, regardless of the money amount. That's called American style options, okay, and not European. European is only on expiration, okay, and also so that's the big difference there. It just, you might be okay with that, and that's fine. Okay, and in some cases, we just want to kind of acknowledge that is a potential, and are you okay with that? Now, also remember when we talk about our examples here today, we're going to kind of look at the market conditions. We got the Fed actually meeting today, okay, and also they're going to be doing the announcement, Fed Jerome Powell, tomorrow at about 2:15 Eastern, okay. Now, a lot of times investors will speculate what actually the Fed might do. Fed is actually trying to really really create something where there is some employment, which there hasn't been, and the second actually mandate is to control inflation, or at least have controlled inflation. I'm not going to say they failed on both, but it hasn't been perfect, okay? So the Fed is actually really trying to kind of make the policy more conducive to growth and employment, but also at the same time, keeping cost a little lower, to say the least. Now, let's take a look at just real quick the markets. When I do this, first off, let's go to just real quick SPX, okay? Now, remember, SPX, and this kind of happened last week, when we got up near the area of resistance, we're kind of still stuck there, okay? Now, when you go into a news announcement like tomorrow, where you can have some bigger movements on policy changes, a lot of investors kind of waiting to see what they're going to do tomorrow. That's why we kind of said things like covered calls, collaring, right? Doing buy stops or considering buy stops, waiting for the breakout, time stamping type of trades, right? Where you say, look, buy if it gets at or above this price at after this certain time, like the announcement, etc. So the S&P is just kind of more neutral there. Now, the one thing we would say just real quick to the S&P 500 is when you look at the weekly chart, it's not that it looks bad. It's just kind of more consolidating. Okay. Now by the way, that does not mean everything's consolidating, but a majority of it will be. If we go back and look at this chart, you'd have to say that after the big monster move that it's had, it's given hasn't given a whole lot back. That's not bad. Okay. You don't hear us complaining. This big move off the bottom, we haven't even pulled back to the bottom of that or hit the line of the 23% retracement. The higher we stay towards the recent high, the greater the probability that we could actually take out the high. Okay, so S&P kind of consolidating, but that's after a big move. Just real quick, where's the Russell? Well, if you look at hi-ho Russell, I was going to say hi-ho silver, but let's also include hi-ho to the Russell. Now, if you look at the Russell, we always kind of say that if we want to see these higher lows, let's just circle the red and green candles side by side. There's one. Now, what you're going to notice is there's your pole, here's your fleeg. And what you're now going to notice, if you take a look at that wasn't much of a pullback. 1 day pullback, 2 day pullback. What does it tell us? Momentum. You don't pull back more than 3 days. This is a lot stronger than you think it is. Now, the biggest actually thing is 1 day pullback, 2 day pullback. We're going to circle the red and green candle. The red candle is where we stopped pulling back. The green candle is where we started going up, hence higher low. And that higher low is higher than this one. Now, why on earth would you be making higher lows at an area of resistance if investors did not think we could actually break above that? So we got to kind of go back to the weekly chart and say, are these smaller caps heading towards higher ground? Again, I'm just in the messenger here. I'm just stating kind of what we're seeing is that looks like we're trying to get a crossover on the weekly chart, okay? And we could be sitting here where we might be trying to get some a continuation pattern of this recent trend. Now, is it sometimes normal that you kind of get a little year-end push? Yeah, okay, not all the time, but sometimes you can get a year-end push. Now, you got to think about something just real quick. When we look at, let's say, stocks, when I say stocks, and I don't want to say stocks, okay? Let's just say equities, and I want to think an asset class, okay? We're going to actually say C for commodities. So E for equities, C for commodities. I'm going to say R for real estate, which, yeah, you get that. And I'm also going to say, for example, let's say FI for fixed income, okay, fixed income. And I'm also going to kind of put over here maybe like FX for, let's say, currency, okay? Now, people have a choice of where they're going to put their money, right? So number one is when you look at FX, the US dollar has been down and flat. There's no real new change in that per se. If you looked at fixed income, we've seen rates just hunkering right around the 4%, okay? Now, could some investors invest there? Yeah, sure. Is that different than what it's been before? I'm not sure if I would say that, okay? Kind of still is what it is. Major trend changes, I don't see that, at least right now. The fixed income or the interest rate has to do with real estate to some degree, and that has been very sideways, okay? And when you look at, let's say, the C for commodity, man, the biggest actually thing is we've been seeing the gold, the silver, which breached above 60 today. Hello. And let's just kind of throw in there C for copper. Now, by the way, I'm not saying bad things about palladium or platinum. We just don't talk about them typically. But gold, silver, copper, and then oil has been down. And if you get actually oil down, that actually typically means the airlines might be up. Now, why did I go through this whole exercise? Because portfolio managers only have so much places to put the money, okay? Now, notice it doesn't say pillow, okay? Pillow or over here, stuff the money underneath the pillow. Because if you stuff the money underneath the pillow, there's no rate of return, okay? So the biggest actually thing is these equities are, that's why there's been some movement in equities. Has there been some movement in commodities? Yes. Real estate, still very flat. Not everything, but probably the majority. And I think you're probably talking about there's really three places. 1, 2, and probably 3. Okay? Now, I'm not saying that people don't invest in currencies or real estate, but those have just kind of been where the trends have not been as strong. So from this little exercise, we should understand now that, like, wow, if I stuff my money underneath the pillow, what is the real rate of return? You lose money. It's called inflation, just eroding the power of that US dollar. Okay. So this is why people look at equities as a place to try to get a real rate of return. Now, when we actually take a look at, let's say, speaking of gold, let's take a quick look at just gold real quick. And we're going to look at an example. When we look at gold, again, what the investor wants to see is, are these moving averages starting to pinch and come towards each other? What you're going to see is that 10-week moving average, we did go green on the 17th, right before Thanksgiving. And then what you're going to now see is it's still green, and your 20-week moving average has been green. So what does that tell us? Trend is still up there. The momentum has been coming back up. Some investors might be thinking, hey, could we be getting a higher low setup on gold? Now, if we go look at the daily chart for just a second, this is what it looks like, kind of carving itself back up. Now, you don't have to trade this chart. You might say, I'm going to look at AM or NEM or some of the gold type stocks and so on, or something that tries to track that. Now, the other thing is what actually hit today. Geez, I said 60. I mean, I didn't mean to lie. Or misspeak. I said that it hit 60. I didn't know it hit. Nobody told me it hit 61 as we were talking. That was a pretty big push, okay? Now, if you go back to this just real quick, little run to the upside, let's count it for us. 1, 2, and then all of a sudden you see what we call a close higher day. Close higher day is just saying, hey, look, we closed up, but we didn't close above that day's high that I'm circling. Why did you circle that day's high? Well, because of the 2 red candles, day 2 was the lowest. And if we circle that high, if we close, we traded above it. We just didn't close there. So if we're looking at this candle to close, we'd say, hey, this is just what we call a close higher day. The investor who has understanding would say, I'm looking to see if there's a gap the next day. Now, that actually also means that the silver prices actually go up because some of those actually stocks actually go up as well. And what you're going to see is it went down for a day and then fired away just this morning. Okay, and some of you saw that. But a decent push there. By the way, that's a 4% push. Okay, now, speaking of that, let's kind of go back to just real quick one of the stocks in that space. And I want to go look at NEM for just a second. Now, remember, when we talk about, let's say, gold stocks, we could, for example, just real quick, go to Analyze for scan. Let's go Stock Hacker. Let's go just real quick. I just want to see a list of stocks, okay? So if I go to scan Stock Hacker and then just go scan in, I'm just going to go down to the industry group, basic materials, of course, okay? And if I go down and say metals and mining, okay? So that's not too bad. I want to see everything in that space. I'm saying over 40 bucks, and I'm going to say over 250,000 as far as the volume. Now here's the problem. This is 250,000 right now. It has to be higher than that. So the list of gold stocks is smaller than you think, almost on 2 hands. Almost on 2. Not 100 stocks, not 50, 10. And the reason why I say it like that is a lot of times people say, oh, there's so many stocks to look at. I can't, it blows my mind. Well, you can't say that in the gold space, in the silver space. There's only about 10 companies that really actually have some decent volume. Now, could you buy some that have lower volume? Of course. But there's risk with that, okay? Now, what I'm going to do is one of the stocks, and I'm also going to pull this up just real quick because I want to show this. One of them that's actually getting a little push is the ticker symbol PAAS. Now, it's up 4.3%, 4.36, 10% here today. Let's go to that just for a moment. I just want to see what this looks like. Okay, now, let's start here because silver's getting a stronger move than gold, okay? Now, a lot of times when we're now the reason why we look at the indexes, some of the prices, we want to kind of know where are the moves. When I started investing, I felt like all I did was I was a professional searcher. All I did was just searched and searched and searched. I didn't really know that if I just focused on the stocks that probably had higher liquidity, that would be a potentially good starting point. Second, when I found those stocks, what is an example of a bounce or a breakout slash crossover? Well, today, if we look at this so far, why is there a green dot on the chart? Because it's saying we're trading above the high of the low day. 1 day, 2 day. Second day's the lowest. Why is that a green dot right there? Well, we're trading above yesterday's high. That's what it means. Okay. Now, why don't you trade this before? Because we do all the trades in class. I got to wait for the class. Okay. Now, in this example, when someone gets a move of 10%, someone might say, well, too high, missed it. Well, you got to remember there's different strategies. Okay. Now, sometimes you can actually get something to move 10%, and that might mean the volatility might be also pretty high. Now, let's go take a look at that. Speaking of volatility, we're going to go to the trade tab for just a second and see what is the volatility. Well, lo and behold, now you're going to see that on the stock volume, they've already traded 6.3 million shares. Now, a lot of times people say, I like to see the stock have higher volume. Great. Do I look at the volume? Not that often. Okay, why? Because most of the stocks I trade we look at trade over millions of shares anyway. If it's higher volume than average, could you take away some points at that moment in time? Yeah, you could. I mean, just there's more interest. That's what it tells me. There's just more interest. Okay, it's not a bad thing. But the price also, what's happening with the price kind of tells us something about that too, right? I mean, don't forget that. Now, the one thing is just because the volume is actually there on the stock doesn't mean it's there on the options. Now, what you're now going to notice is the open interest right here, that is not a lot. So if we go look at the December expiration, that is, well, actually, excuse me, right here. You got more activity on the call side than you do on the put side. The puts, that is not a lot. You're less than 100 on all of them. Now, that's for the December. If you go to the January expiration and we say, okay, do we have anything more here? There we see a little bit something. We can see where those investors are hiding, okay, or doing those trades. So when we look at the open interest column on the call side, open interest, there we go, okay. The volume actually here today, there you go. Bid-ask spread, 20 cents over there, 10 cents over here. Open interest on the put side. You're going to see that, for example, it's less than the call. Now, we've got to ask the question, could people be buying the puts? Buying the puts, thinking the price isn't going to go down. They could. Maybe not as much as the calls. Now, could they be selling the puts? Yeah, they could. The con about selling the puts is a cap strategy. Why do you think the calls are getting so much activity? Could they be selling the calls, which is bear strategy? They could. But why do you think the calls are actually having so much activity? They're speculating that it's going to go higher. They want to actually have something that is almost stock-like to a degree. If someone bought an in-the-money call, like a 40 call, well, it's like owning 86 shares of stock, okay? The difference between a long call, it's the right to buy the shares at the strike price from now to expiration. You're going to see in this case that the delta is 86. It's a deep in-the-money call. Some investors, they buy deep in-the-money calls, probably with a delta greater than 70. So they're getting almost a stock-like movement in terms of having a higher delta. Now, that's not going to be our example here today, but what I'm going to do is I'm going to come to, let's say right here, to the 45 strike. Okay, now let's think about this fundamentally for just a second. Let's say you're the CFO of Pan American Silver, and silver just went over 62, and you're in charge of seeing the sales and the earnings per share and the cost of the company. Well, if you're able to sell your product for way more than you thought, what's the revenue doing? If you're playing, revenue probably is higher, okay, assuming you sell a decent quantity. What's the earnings per share like? Assuming the costs are actually staying somewhat under control, it's probably pretty high, okay? It doesn't take a whole lot to understand that. And the biggest actually thing is if we right click on this, we're going to do buy. And then what we're going to do is going to go, in this case, collar synthetic. Now, we know that you could do a single option, but then you could also kind of do dual options. Like you could buy a call and sell a put. If you do those together, that's what they call a long synthetic. Two single option strategies. Now, if we did that buy collar synthetic, we're going to buy the call and sell the put at the same strike. Now, what you're going to notice is the debit is 308. Tell me what the break even is. What's the break even? That's simple. You have a right to buy the shares at 45 and you paid 308 overall, so it's going to give us 4808. Now, what's kind of interesting about this, you might say, well, where's the stock now? The stock now is at 47.92. So we need the stock to go up 16 cents in about the next 5 weeks. Do you think there's a chance it could go up 5 cents? Oh, there's a chance. Okay, now, what we're going to do in this case is we're going to set the stop right underneath. We're going to go single order. First trigger is SEQ. We're going to right-click on that green line, say flip the order. Now, what we're going to do is it creates now red. So the green is the buy, the red is the sell. We're going to go back to the chart, pull it up, and if you look at this, where's the today's open price? Today's open price, let me mark this down for us so we can follow along. Today's open price is 44.18. Okay? 44.18 is today's open. Now, what I'm going to do is I'm going to take less 3%. Why? Because it's lower than $50 to be consistent with what we normally talk about. 44.18, less 3%, 42.85. 42.85. Okay? Okay. Now, if we did the exact same strikes, the delta would be 100. It's moving like it's stock. So in other words, if we, for example, got in at 48 instead of stop at 42.85, we could see approximately what that potential risk would be. Answer, it is going to be about 42.80. I'm moving it to where that is. It's about $5.14. So, and that's from the current price to where that stop, the conditional order is to exit. Now, when you say that 42.85, where are we going to put it? Well, let's go back right here. We're going to go limit, market, day to GTC. And why did you say conditional? Because the exit of this position is conditional upon the price of the stock going to 42.85. Okay? So that 42.85 is 3% below today's open. So if the stock is at or below that price, 42.85, sell it. Okay? And what you're going to see is it's selling the combo or the long synthetic. It's selling the call and buying the put back. Now, just real quick, what I'm going to do is I'm going to kind of hold that there for just a second, and I'm going to save that, and we could go confirm and send. There are going to be a commission for buying the call and selling the put. When we talk about, let's say, a target price, well, when we're talking about a target price, there's actually a little push right there. I should say pullback, where we pull back to, where we ran up to, and the distance there, we got about 36 to 46. Now, what we were taught in day one of technical analyses is, hey, we're going to say, where did it pull back to? I'm going to say about $43. And if we add if, we don't know if it's going to do this. If it went up the exact same, if it did, it gave us about a 53 price target. Okay? Now, what I'm going to do in this case is I'm going to go ahead and actually just kind of tee this order up. And now what you're going to see is there it is right there. Now, any questions with that? Any questions? Now, here's what I'm going to go ahead and do. Let me just kind of fire that just real quick before we go look at NEM for just a moment. We're going to go back real quick. You got to put that in the paper money account. Let's kind of put that there. I'm going to quickly just put that. I want to make sure we can track that over time. There it is. And if you want to see me do it again, I'm just showing it one more time in that paper money account. Single, the first trigger is SEQ, right click, create opposite order, day limit, limit to a market, day to GTC, 48.25. And if you don't mind, I'm going to just come and kind of add that one extra piece. What's that one extra piece? I'm going to put the target price. Okay? Right below that mark, we get greater or equal to, I'm going to put 53. Okay? So $53. We got a target price and a trigger. So this is triggered to get out of the position. If we go higher than 53, this is if we go lower than 48.25. We're going to go save. Confirm send. There it is. All right. Now, one thing I want to kind of make sure we quickly understand real quick before we go back to the NEM is if you look at, let's say, the delta, 69 delta. So if we buy the call, so when you look at this table, this is assuming that you're buying, okay? So that's why when we look at the delta column, it's plus 69. You look at it, for example, the delta on the put side, it's negative 31. Well, the only way you get negative 31 is if you buy it. It's not if you sell it, because if you sold it, it'd be 31 positive, okay? So we're going to take a little plus there, and if you add 69 and 31, it's going to have 100 delta. Now, that's significant because we're saying, look, if the stock goes up $1, how much do the options approximately move by? 100. Stock goes up $1. The option overall moves up by approximately 100. So it's the movement in the stock price over the movement in the option price. The delta is a conversion from going from stock to options. It's a conversion. Now, what I'm going to do is let's go back just real quick to NEM. Now, NEM is kind of the one that we brought it up yesterday, and I'm going to go back and just look at this. Now, some people might say, look, the investor is nuts. Why would the investor actually buy now? Well, have you ever heard of that bad word called anticipation? You're anticipating. You're anticipating. What are you anticipating? Now, I want to kind of give you an example of anticipation, okay? There's a commercial on TV where there's people like me that are a little older. They go to a football game, and they plan to go to the game, and they plan to leave at the end of the third quarter so they could get ahead of the traffic. You know which commercial I'm talking about? No names, okay? No names. Well, people do that in the stock market too. What do you mean by that? Well, if someone is actually saying, look, NEM is not selling baby dolls, diapers, bottles, they don't sell pillows, the stock price could be related to the sales of the product or service that they're selling. And if that product or service that they're actually selling is increasing in value, there's more demand. Well, there might be demand potentially for the stock that could be correlated to those prices. Now, some people say, well, what I'm going to do is I'm going to wait to get in when the stock goes above resistance. Now, if I had $1 for every time someone said that, man, it'd probably be a pretty tall stack by now, okay? Now, some people, it's good intention, okay? But it doesn't always work out, okay? Now, what we're going to do in this case is, let's say the investor says, look, James, I want to get in, but I'm nervous, okay? So I'm going to kind of play that, okay? I'm nervous to get in. So do you know anyone like that? Now, what I'm going to do is in the paper money account, I'm going to kind of play that role. I'm nervous to get in. And every time I get in, it goes down. Have you ever heard anyone say that? Or as I get in, I got in, I set my stop really tight. And then what happened is I got stomped out, and then it went up as soon as I was stomped out. I mean, my gosh, we've heard this 100 times. Now, what I'm going to do is I'm going to go click on the ask price of the stock right there, okay? Now, what we're now going to do is we're going to go down to the options, and we're going to go look at the options for, let's say, the next. I'm going to look and see what these look like. No, double checking. I'm going to go down to the 38 days to expiration, and what we're going to look to do is we're going to try to buy it like an out-of-the-money put. So that right there is we're going to go look to buy the out-of-the-money put with a delta range of 30 to 40. Now, when you buy the put, this is the right to sell the shares at the strike price. Now, when would that put become valuable? That's a question for everyone. When does the put become valuable? If you bought it, volatility increases. Ding, 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 correct answer. Now, Brent, you're not allowed to answer. When does that put become more valuable? The stock gets closer and closer to the strike. True. Or the stock gets further and further below that 87.5. Why? Because that's called intrinsic value. All right. Now, The con about buying the blasted put is you got to pay for it. Okay, this is that big boy, big girl discussion. You want to do this, you got to pay for it. Okay, now in this case, what I want us to notice is if we bought the stock at 92.31 or 92.30, which is right here, that's what we're buying the stock for now. But remember, if we buy that put, let's assume that it goes all the way to zero at the expiration in January. We would need the stock price to be, now remember, is this the expiration today? No, it's not. We're assuming that we lose 100% of that. Now, if we did, that would actually tell us that we would need the stock at expiration to be above 95.10. Okay, 95.10. If I said, hey, we are at $97 at expiration, how much did we make? Well, if we're at $97 at expiration, we made about $190 or $190. Wonder if I said we're at $100 at expiration. Well, if you're at $100 at expiration and your break even was 95.10, you'd be up about $4.90 or $490. Wonder if it was at 98.10, it'd be up $3 or $300. Wonder if you're at 94.10 at expiration. Well, that actually means that you're down $1, you're down $100. See how that works? Just kind of run what the break even is and run the scenario. So in this case, what we're going to do is we're going to say, look, we're going to buy the put, and we just want to have a right to sell. We want to know that there's a defined risk. So that defined risk is from 92.30 down to 87.50. Now, when I woke up today, I was kind of thinking about how many people want to be a millionaire. Okay? Want to be a millionaire. I think most people could say, I want to be a millionaire. Sad to say that $1 million is not that much money anymore. I mean, it's just sad to say, but let's just get over that. Now, here's the problem. If someone wants to be kind of successful with investing, it takes principles of investing over time and then planting capital. So if we didn't plant a seed of capital, I don't get any harvest. Does that make sense? Now, let's say there was a 55% chance of being right. All right, it's not 100. But if we don't plant anything, there's a 100% chance of getting nothing. Now, some people would rather have a 55% chance of being right to something than a 100% chance of nothing, or 100% chance of literally there's no growth at all. Matter of fact, you're even going backwards. And that's why people try to use principles over time with proven practices and applying capital, seed, and trying to get some of those trades or investments to work over time. We are in the seed business. We take capital and we try to put it in areas that we think could potentially grow. A lot of times, sometimes people might not plant the seed because they're scared about being wrong. We know we're sometimes wrong. That's why we position size and use strategies, setting stops, married puts, and so on, callers, to try to actually have a way where we define risk while trying to get some type of harvest. Now, what I'm going to do is here, if we go confirm and send, we actually now have the shares there, the put there. Remember, this is not a put until infinity. This is a put until the 16th of January. Okay? Now, are we trying to have the put to become worth something? No. We want the shares to go up. And we want the shares to go up above where that break even is. That's what we want. Okay? Now, what I'm going to do in this case is I'm going to send that. And now what you're going to see, we're going to send it. Okay? Now, yes, I was born in Lincoln, Nebraska. Do I have a corn cob for my favorite team like someone in Wisconsin has for those Green Bay Packers? Of course I do. Okay? But I'm not going to wear it here in class. Sure. Now, let's also go back to, so trade number one we did was which one? What was the number one trade we actually did? Example given. Well, we kind of said, hey, let's keep an eye on gold just real quick. Just keep an eye on it. Gold was not moving as much as silver. It wasn't. Okay? Silver was actually getting a little push. We said, hey, what if we ran a scan and a quick scan in 30 seconds or less? We said, can we just look in, for example, that space of just the materials and went to metals and mining? Could you just tell us maybe a list of 10 stocks, maybe that might be getting the move. And when we looked at, let's say, what was getting a little volume, it was really the silver one. Surprise. The other one that was actually getting moved that we talked about was that NEM, okay? And we are going to keep an eye on AEM, but the AEM is not showing so far because we lowered the volume. And if we did that, I think AEM should probably come up on that list as well, okay? Now, so we did PAS, PAAS, double A, excuse me, PAAS. And the other one we actually did, let's just double check, was NEM. Now, the comment was just real quick, can you explain the gold-silver ratio to the movement of silver? Now, I do think there is like you could type in maybe and I'm not sure, at least right now, I'm not sure of the ticker symbol that looks at that ratio, like gold over the silver. I know if we actually looked at the XAU, which is the gold silver index, but I'm not sure on that what the breakdown is on that. So for example, Thea, let me kind of look at that for Friday and kind of find out what is the breakdown of, let's say, gold to the silver. What we know, well, I can't pull it up on this. I'd have to even bring that up on Friday. What we do know is if I actually pulled up, let's say, gold, okay, itself, and we overlaid, let's say, and I'm just going to do a quick study, compare with, what I'm going to do is I'm just going to add that. Let's compare with custom symbol. I'm just going to kind of see if we can get it. Now, the problem is there's going to be a little difference. So the candlestick chart, that's gold. The blue line, that's silver. Okay? So when you're asking the question, please explain the gold-silver ratio. Any ratio is not going to stay stagnant. It's going to be dynamic and moving. When you look at this chart, what we know for sure is silver tends to be more of what we would call the higher volatile trade compared to gold. They both have, when one goes down, the other one goes down. When one goes up, the other one tends to go up. You're going to see that sometimes these charts are almost overlaid on top of each other, but especially lately, that line is broken apart from gold more than ever. So if we were saying, what is the ratio of one to the other? Well, the ratio has become a lot more silver to the gold currently because the lines are actually starting to almost separate a little bit more. Why is that? Well, when people are wanting to kind of take a higher amount of risk, they probably pick silver over the gold. If they're trying to say, look, I want precious metals, but I want to be a little bit more not as volatile, they're probably actually choosing maybe potentially gold, okay? Now the comment came in. Thank you, Chris. Let's actually check this, and I'm just double checking. Yeah, let me actually dig into that a little bit more. Okay, all right, good question there. Now, real quick, I want to go to some others just real quick. They were now, the other day, we kind of brought up the financials, okay? And the financials, when we look at financials, we could actually, for example, look at IXM, or you could use a different ticker, right? IXM is actually getting a decent push. We're talking about the financials, okay? Now remember, the Fed is actually trying to some extent help employment. Number two, which by the way hasn't been super strong. Second thing they're actually trying to do is trying to tame or control inflation, which both affect financials, okay? Now, a couple of these stocks in financials that have actually gotten a pretty decent push is Goldman Sachs, of course, MS, Morgan Stanley, shooting to the upside, another higher low. Now, you got to remember BAC, which is not broken out. But remember, if you get Goldman Sachs breaking out to the upside, Morgan Stanley breaking out to the upside, could Bank of America be on a short list to watch as well? Well, if they're correlated to some degree. You see Citi breaking to the upside, Wells Fargo, the next stage, broke to the upside. So you probably say if there is one that might try to be potentially the catch-up trade, meaning it's lag and it might try to move up with others, it could be Bank of America. But the other one I also want to kind of bring up here is JP Morgan. Now, if we take a look at this real quick, Now, does JP Morgan look like Goldman Sachs, or does it look like Citi, et cetera? Not yet. But when we actually go back and look at the 3 weekly chart, this kind of looks like there's been something that's actually been increasing to the upside. Now, I want to go back to that a little example of planting seeds of capital, okay? Welcome to seed day, okay? Now, remember, if the investor doesn't plan anything, eventually, I mean, if the investor just stayed cash their whole entire life, you just get the erosion power of inflation on the dollar. That could be a whole class by itself. This is what it is. That is, by the way, could someone choose that? Sure, okay? Now, if someone said, well, that's the risk of just staying in cash, I want to invest the cash in something that's getting a higher potential rate of return than inflation, okay? Hence other asset classes. Let's kind of show the example of JP Morgan, and I'm going to kind of look at this as far as selling a put. Now, remember, when we talk about selling a put, that is the obligation to buy the shares at the strike price, okay? Now, interesting thing enough is when we look at this, you got 315, 310, 305, 300. So the question becomes, where would the investor not mind in being the buyer of the shares potentially if they consider the strategy? Well, let's say the investor said, James, when I go back and look at this chart of JP Morgan, I'm kind of seeing a support level right around 310. Second area, I'm seeing a potential support area is about 300 or 300, depending upon where you live. And also if we say, let's say the 295. Okay, well, we know if we actually sell the 310, the premium is going to be higher, okay? If someone sells the 310, they're saying, look, I don't mind owning the shares. There's a greater chance of the stock to be below that strike, hence a bigger premium. Now, for some investors, they might say that one of the risks of the strategy is it's susceptible to volatility increasing. Second, you could have assignment risk, which you do if you sell it. And the third thing is here, if the stock goes below the strike, the risk is that the stock could fall down to zero. Noted. Could we try to curb that somewhat? Yeah. We're going to go right-click on that bid price, and we're going to go sell, and we're going to go to vertical. Now, this is not your typical vertical here. And what do we mean by that? Well, what we mean by that is we're going to right-click on that 310, sell vertical, and we're just going to widen the strikes out. So this is your classic sell the put, which we're doing, 310, 310. But what we're doing is we're coming down to where we have a strike lower than a 10 delta, and we're saying, hey, look, we're going to buy the 270. Do we ever think it's going to become worth something? I'm not planning on it. But if it does, it means the stock came down and or volatility went up a lot. Now, when you buy that put, it decreases the credit. When you decrease the credit, you actually increase the break even because there's less credit. So the last, third and final trade is JP Morgan. Keep an eye on some of these financial stocks. Now, that doesn't mean you have to. You can look at things like the other one is keep an eye potentially on Bank of America. Okay? These are not recommendations. I teach a class. I'm on paper money. There are examples of strategies that we cover in class as an example, okay? Now, remember, when we take a look at this, that max loss is assuming the stock what? Goes down to 100. Goes down to zero. So you just have to understand that. They're saying if JP Morgan went to zero, okay? Now what I'm going to do is send the order, note the commission there, send it, okay? So I call this a short wide put spread. Short wide put spread is really a cash secured put with just downside protection. All right, I'm out of my time here today. We went over, again, we did PAAS, NEM, JPM, and for Wednesday, Thursday, Friday, we'll keep an eye on some of those other stocks we actually talked about. And also I will kind of follow through on the example that they asked as far as that relationship, which is dynamic, moving over time. But it is worthwhile to note kind of which ones are they correlated still, or is that correlation starting to break down? Now, we got Cameron May coming up next. Remember to subscribe to the Trader Talk channel. It's free. Go to YouTube, type in Trader Talks. And what you're now going to also recognize is for this class, which I will post in the chat, there's a playlist. Bookmark that playlist so you can see all of our previous classes. Thanks to Brent and thanks to all of you as well for your comments and your participation. Remember, with what we talked about today, all investing involves risk. Short options can be assigned at any time prior to expiration. We talked about that and showed that. And also remember that when we talk about investing, beware of what reward is and risk, and that can change based upon the strategy. As an investor, you get to pick the strategy that you would consider for yourself. This has been in the Investing Master Series for December 9th. Thanks so much. I'll be back on tomorrow, same time, same station, on Trading Growth and Value. Take care. Bye-bye.